Mike, you want to walk us through what this job openings index is?
Definitely. When we think about the labor market in 2024 and our outlook, this we think gives a good idea of how we look at the data, how we frame it out. The first thing is to look at, when you're looking at demand for labor in 2024, you got to look at job openings. Traditionally, you would look at the JOLTS data. JOLTS data is very volatile, so we've done the 3-month moving average here, but we also recognize that response rates for the JOLTS survey have been falling, really since even before COVID. And so we supplement the JOLTS data with other high quality private sector data points. Specifically, we use Indeed job postings as well to create our own job openings index. And one thing you see now is, if you look at the JOLTS data last week and the Indeed data as well, job openings are now below the pre-COVID trend. That's a tremendous amount of progress in terms of rebalancing the labor market. When job openings were at all-time highs, that's when quit rates were also at all-time highs. And if folks are quitting their job, that is a sign of confidence in their job prospects because of all these openings. And that also is very inflationary in terms of wage growth. Most folks, when they quit a job and go somewhere else, they expect a pay increase, or else they'd rather stay put or find a different job where they would get a pay increase. Right. So that progress, we think, is a big reason why the Fed has knocked the top off of inflation, is because job openings coming down. But as we think about demand for labor going into 2024, we like to take a sector-by-sector approach, which is what we show here on the bottom of the chart. There are 11 broad sectors within the BLS JOLTS report. And we look at how many of those sectors are above trend or below trend. And even though the overall jobs number just fell below trend, there are still 8 out of 11 sectors with job openings above their pre-COVID trend. So sort of excess demand for labor. And those are areas where we think there could be catch-up potential still left in the labor market. A huge chunk of the job gains we've seen since COVID are just catch-up, right? Just trying to get back that labor that they lost during the COVID-19 pandemic, but finding it much harder than they thought to get that labor due to structural mismatches, a whole number of factors, right? There is still, if you look at this job openings data, there is still a decent amount of catch-up potential, far less than there was heading into 2023, but there still is some catch-up potential there.
Yeah, you can see that, to your point, you can see that in the progress in job openings coming down closer to pre-COVID trend, that catch-up potential is going to be much smaller in 2023 than it was in 2024 than it was in 2023.
Right.
We can move on to payrolls as well. That's the other side of demand, supply, demand, labor force information. We've got total non-farm payrolls here. Similarly, we've got the pre-COVID trend in gray and the pre-COVID level highlighted here in blue. And you can see some similar themes here, but Mike, what do we need to know on the total non-farm payroll front?
So once again, looking at the pre-COVID trend, you can see payrolls are well below the pre-COVID trend. We have no expectation that in the near term we're going to get back to pre-COVID trend. There are a number of reasons why pre-COVID trend is unattainable at this point. Structural mismatches, increased productivity, doing more with less labor, the increased cost of labor making it not even economically feasible to get back to the pre-COVID trend. So more so when we're thinking about catch-up potential in the labor market in 2024, we're looking at relative to pre-COVID-19 levels. So where were payrolls at right before COVID hit in February 2020? And you can tell in total, non-farm payrolls are back above those levels, but there still actually are 3 sectors that are below pre-COVID levels. And that's leisure and hospitality, made a tremendous amount of progress, but actually still below pre-COVID levels. Mining and logging may never get back. And then trade, transportation, utilities, which are a very broad sector, but they're still under pre-COVID levels. So if you take these 2 charts in totality, and you think about just the catch-up potential, residual demand for labor coming out of COVID, how much is left? If back here on the job opening side, each of these 8 sectors that still have sort of excess job openings, if they're able to fill all those job openings in 2024, which might be a long shot. I mean, at this point in the game, if you still have job openings, you might just not be able to fill them.
Yeah. Some would call that maybe a best case scenario type
exactly. To fill all of the excess openings, could be a long shot, right? There's also just the simple fact that perhaps if you look at the folks that are unemployed and coming to the labor force, maybe they just all don't want to be nurses and bartenders, right? Like that's possible. Or they don't all want to work in Florida or Texas. There are structural mismatches, reasons why maybe these excess job openings won't be filled. But let's just assume they are. And then when you get to the payrolls front, let's assume in these 3 sectors that they get back up to pre-COVID levels of employment. And what does that look like? Those numbers combined, that's about 570,000 jobs of catch-up potential left. And you divide that by 12, that's a run rate of about 48,000 jobs per month in catch-up potential. So that's your starting point as you think about 2024. And then for additional demand, you look at things like, well, what's the economic growth forecast? Well, it's not great. We've talked about how economic growth is expected to slow. We're expecting less than 1% real GDP growth. So there shouldn't be a tremendous amount of additional labor required to meet the demand in the economy in 2024, right? So you look at that 48,000 per month catch-up potential, that is a slowing of the labor market. I mean, that's very sharply slowing. Yeah. If we were to do this exact same analysis, catch-up potential from excess job openings and deficit payrolls, right, below pre-COVID levels, and we were to look at it at the end of 2022, so heading into 2023, it would suggest there was catch-up potential of about 264,000 jobs per month.
Yep.
And what we've actually gotten thus far is something like 232,000 per month. So it hasn't been far off, but the fact that we're still talking about it also means that all of that catch-up potential did not occur in 2023, right? There's still some left. So we understand why it's very easy to, to look at the strength in the labor market we've experienced and just extrapolate it out. But if you look under the surface, it should be much slower going forward in terms of the labor market.
So you have the kind of expected catch-up growth is going to be much smaller in 2024, and it's not even projected to be enough to keep up with the natural growth in the labor force, right, just due to demographic trends.
Exactly. If the labor force participation rate has been going up, particularly since consumer excess savings have been depleted, which we think makes economic sense.
Right.
Once you've gone through your savings, it's time to get back to work. And there were job openings available, so it was easy, right? So participation is coming back up, plus the natural growth rate of the labor force. The economy needs to create somewhere around 140, 150,000 jobs a month just to keep the unemployment rate where it's at, right? And so with catch-up potential of less than 50,000 and economic growth below 1%, that might be tough. And you think about that dynamic, that's a big reason why pretty much every single forecaster is suggesting the unemployment rate will rise in 2024 because of these dynamics. But they don't necessarily mean a recession has to happen, which is key. The idea of just looking at the unemployment rate and saying if it rises above a certain threshold, a recession is imminent, we would want to confirm that with jobless claims. That's something that's in our recession signal. If the unemployment rate rises just because folks are entering the labor force and just not finding a job, that might not be as ugly or have as many negative ramifications for the broader economy as what normally happens when the unemployment rate rises, which are people are losing their jobs.
Layoffs,
right? Quite a different dynamic. So we're going to be really focused on this dynamic going forward. You think it's very dangerous to extrapolate out the payroll gains from 2023 and say everything's all good. We think the Fed knows that, right? And we're going to be watching jobless claims very closely because that's what's going to tell us if we enter recession.
Yeah. We at CAP STRAT will certainly be watching that closely, and another group of individuals that'll be watching that closely, the FOMC, right?
Yep.
That's the major question, is how is the Fed going to digest all of this information and construct monetary policy going forward? So what we're looking at here, the Fed funds rate, futures expectations. Dark blue line is the market expectation for 2024. Light blue line is CAP STRAT's forecast, which we've been talking about the past couple of weeks here. And sort of the changes here are cuts starting to get it priced in earlier due to some Fed speak. What's been going on there?
So we'll introduce the viewers into two new Fed terms, things that you're going to hear as we talk about monetary policy in 2024. Cuts are the new hikes, first off. We've been talking about hikes. Everybody's going to be talking about cuts, when and how much, but also the types of cuts. You're going to hear this in the Q&A most likely, right? There's an idea of an adjustment cut, which means if you hold the Fed funds rate constant, but inflation comes down, well then that difference, sort of the real Fed funds rate, the inflation adjusted Fed funds rate, will go higher. You know, that gap between the Fed funds rate and inflation gets wider, and so monetary policy could become even more restrictive even though the Fed's done hiking. And so the idea of an adjustment hike is the Fed wouldn't want that, right? They would want to maintain the level of restrictiveness. So if inflation comes down, they would want to chase inflation down by lowering the Fed funds rate, right? So there's that's one idea. And then the other is one called an insurance cut, which is this idea the other side of the Fed's mandate is full employment. And employment is full, right? We just talked about how there should definitely be slowing hiring in 2024. But right now, there's still a very low unemployment rate. Labor is still hard to come by. Easier to come by than it was, but still very hard to come by. So